Welcome back to the Profitable Mindset Podcast, everyone. You know, we dive deep into strategies and market analysis all the time, but today we're tackling something just as crucial.
Yeah.
The profitable mindset. Like, even with a killer strategy, sometimes it feels like you're battling your own brain.
You're exactly right. A solid trading strategy is essential. I mean, crucial, right?
Absolutely.
But I've seen so many traders, I mean, really talented traders, they've got great systems, but they just can't seem to get out of their own way emotions, you know?
Yeah, that makes sense. So where do we even begin with this whole profitable mindset thing? What are the fundamentals?
Well, for me, it always comes back to the 3 pillars: discipline, emotional resilience, and that growth mindset. Discipline, that's what keeps you on track, keeps you following your strategy, even when, you know, things get a little crazy and you're tempted to.
Right, because we've all been there.
Yeah.
Especially when the market takes a dip.
Suddenly it's like all logic goes out the window. And
it's like your brain just short circuits. You're not thinking clearly.
Exactly. And you end up making decisions you wouldn't.
Yeah, you wouldn't even consider normally.
Literally. Right.
Exactly. That's where that emotional resilience comes in.
Okay.
Being able to ride the waves, the ups and downs, without letting fear, you know, greed take over. You know the market's going to test you.
Absolutely.
It's designed to test you emotionally. And the key is not letting those emotions completely derail you.
So it's almost like we need to retrain our brains to see those market swings, like when the market drops, as an opportunity instead of just like panicking.
It's all about perspective.
Right.
You know, those successful traders, they don't see losses as failures. They see them as feedback.
Interesting.
It's a chance to learn, refine your approach, you know, and that ties directly into that 3rd pillar, the growth mindset.
Okay, I like that. So let's unpack this growth mindset a little bit. What does that actually look like?
When we're, you know, trading.
It's about always striving to be better, to improve. The market's always changing, right? And we have to change with it. Always willing to learn, to adapt, never being satisfied with, okay, this is good enough.
Right.
Because it never is.
So are we essentially trying to outsmart our own brains then?
That's a great way to put it. We need to really understand ourselves.
Right.
You know, our psychology, how our emotions, our biases play into our trading decisions. It's crucial.
And I think so many people would be surprised, right? They don't realize just how much their emotions are actually impacting their trading.
The market has a way of like pushing our buttons, you know, our deepest fears and insecurities. Greed, the fear of missing out, fear of loss.
Yeah.
These are powerful emotions and they can lead us down a very dangerous path.
So how do we start to manage that, right? Become more aware of those emotions, those biases, so we can at least try to make more rational decisions.
Awareness is the key, right? Once you understand how those emotions can influence you, then you can start to develop techniques, you know, ways to manage them.
All right, so let's get into some of those techniques. What are some things that people can do to manage their emotions, make better trading decisions?
Journaling.
Okay.
I'm a huge believer in journaling. Keep track of your trades, but also your emotional state.
Gotcha.
Before, during, after each trade.
Interesting.
You'll be surprised what you start to notice. Patterns will emerge. You'll see your triggers, you know, what sets you off.
So, like, by writing it down, we're actually forced to confront those biases, those emotions that maybe we weren't even aware of before.
Sometimes we're not even aware of it.
I've tried journaling in the past, but I'll admit I wasn't always the best at keeping up with it.
Consistency. That's the key. Think of it like a training log. You know, athletes, they track their workouts, they track their nutrition. Successful traders, they track their emotions. It's just as important.
That makes sense.
Yeah.
So journaling's one tool. What else can we do?
Mindfulness. Practices like meditation or even just deep breathing.
Right.
Incredibly helpful, calms the mind, reduces stress, and you start to create that sense of detachment from the constant ups and downs of the market.
Yeah, I can see that being really beneficial, especially on those days when the market is just all over the place and you're feeling...
Especially on those crazy days.
That anxiety.
It helps to center yourself.
Right. It's like creating that mental space, that calmness before you...
Yeah, before you even look at a chart.
Even look at a chart.
Exactly.
So journaling, mindfulness, what other strategies can we use to really manage those emotions?
Routine.
Okay, a routine.
Yeah, a structured routine can make a world of difference. It reduces decision fatigue, enhances discipline,
So are we talking about a set schedule, like a predefined plan for
Absolutely, yeah.
each trading day?
It's like, think of it like an athlete getting ready for a competition. They've got their training schedule, their diet plan, their rituals.
Right.
Successful traders, they approach the market the same way.
With that level of...
That same level of preparation.
Okay, I like that. So what would a winning routine for a trader look like then?
Start with a strong morning routine.
Okay.
Something simple. A 10-minute walk, a quick workout, whatever gets you going.
Yeah.
Clears your head, gets the blood flowing, starts the day on a positive note.
I could see that being helpful, especially if you know you're walking into a
absolutely.
stressful trading day.
Especially in those tough days. Then spend some time, even if it's just a few minutes, in mindfulness meditation.
So you create that mental space, that calmness.
Yeah, that calmness.
Before you even
look at the charts.
For looking at what's going on.
Precisely.
And then review your trading plan. Look at the key markets.
Yeah.
Set your alerts for potential trades you might want to take.
So you're not just reacting.
Right.
You're going in with a plan.
So you're not just reacting to the market.
Yeah.
You're going in
right.
with a plan. I like that.
And don't forget, schedule breaks throughout the day. Even just 10 minutes away from the screens can make a world of difference.
I used to think I had to be glued to the screen.
Right. We think more time equals...
I've realized those breaks actually help me.
More opportunity, but that's not always the case.
Make better decisions.
Sometimes it's the opposite. You get fatigued, you burn out.
Totally.
And then you start making those bad decisions.
And what about after the market closes? Is there something that we should be doing as part of that routine?
Absolutely. Post-market analysis. That's key.
Okay.
You've got to review your performance metrics. Did you make any mistakes? Did you follow your plan? And then use that to adjust your strategy for the next day.
So it's a continuous cycle, right? Preparation, execution, and
cycle.
Reflection. Sounds pretty comprehensive.
It is. But here's the thing. It's not a rigid thing. It has to be adaptable. Different market conditions, different personal needs.
So if the market's especially volatile, you might need to spend more time prepping, maybe adjust your position sizes to manage that.
Exactly. It's about having a framework.
Right.
But being flexible within that framework.
Okay, this is all making sense, but I feel like we're missing a big piece of the puzzle here.
Mm-hmm.
Risk management. I know it can be kind of a dry topic, but it's so important, not just for protecting our capital, but also our mental well-being.
Risk management, it's more than just a set of rules. It's a way of thinking.
Okay.
It's prioritizing capital preservation above everything else.
I think a lot of people get caught up in, they hear about these huge wins.
Oh yeah, the big wins.
And they kind of forget about the importance of protecting what they have.
It's human nature, right? That focus on the reward. Mm-hmm. But neglecting risk management, it's like building a house without a foundation. It might look good at first, but it's not going to last.
So how do we actually develop that risk management mindset? Where do we begin?
Well, it starts with understanding the basics. Things like risk-reward ratios, position sizing, stop-loss orders. Those are the building blocks. Let's start with risk-reward ratios. That's basically evaluating how much you could potentially make on a trade compared to how much you're risking.
Can you give us an example?
Sure. Say you're looking at a trade where you're risking $100 to potentially make $300.
Okay.
That's a 1.3 risk-reward ratio. For every dollar you risk, you're aiming for 3.
So we want to make sure that potential reward is always bigger than the risk.
You want the reward to outweigh the risk.
We were taking.
Exactly.
Okay, what about position sizing? How does that fit into this whole risk management idea?
Position sizing is figuring out how much of your capital you're going to allocate to each trade. Yeah. It's like, even if you have a setup you absolutely love, you don't want to go all in.
Right.
You got to protect yourself. A common guideline is that 1% rule.
Okay.
Risk no more than 1% of your total capital on any single trade.
So if I have like a $10,000 account, I'm risking no more than $100 per trade.
Exactly. Simple rule.
Okay.
But it can be incredibly effective.
Okay, and then stop-loss orders. Those seem to be a big
You're
part of this whole risk management conversation.
Stop loss, it's an order that automatically exits a trade if the price moves against you by a certain amount.
So it helps to limit losses, even if you're not, staring at the screen every second.
Exactly. It's like an insurance policy for your trades. Imagine you buy a stock at $50, you set a stop loss at $48.
Okay.
Price drops to $48, your order is automatically sold. You limit your loss to $2 per share.
And I know there are different types of stop-loss orders, right?
There are, yeah. Fixed stop loss, trailing stop loss, technical stop loss. They all have their pros and cons.
So choosing the right one kind of depends on your overall strategy.
Exactly.
And the specific trade you're looking at.
It's important to understand the different types and how they can, help you protect your capital.
Okay, this is all making a lot of sense, but I've got to be honest. Even with the best risk management plan, taking losses is never...
It's tough.
Psychologically, it's tough.
It's tough.
It can shake your confidence.
Absolutely can. You're right. Losses are a part of trading. It's inevitable. It's how you handle those losses that really separates the successful traders from everyone else. The key is shifting your perspective. Instead of looking at those losses as failures, look at them as feedback, as opportunities to learn and get better.
So asking yourself, like, okay, what can I learn from this? Like, what did I do wrong? How can I avoid making that same mistake again?
Exactly. And your trading journal is such a valuable tool for this. It's not just about tracking your wins and losses. It's about really digging into those trades, understanding why things happened the way they did.
So I might write down things like, I entered this trade way too early, or, man, I totally let fear take over and I exited the trade way before I should have.
Precisely. And as you document your thoughts and your emotions, you'll start to notice those patterns emerge. You'll see those recurring mistakes, and then you can start to develop strategies to, address those.
And over time, as we learn from those mistakes, our trading should theoretically improve.
It should.
But I gotta admit, even with that growth mindset, there's one thing that really shakes my confidence. Those consecutive losses. Like when you're in a drawdown, it just makes you question everything.
Drawdowns, they're a psychological test, no doubt about it. But even the most successful traders experience drawdowns. It's just part of the game.
Okay. But how do we handle those drawdowns without letting them, completely derail our confidence? It's easy to start doubting everything, even the strategies that have worked for you in the past.
You're right. It's tough. One of the best things you can do is just take a step back. Reduce your position sizes, minimize the impact of each loss, or even consider taking a break from trading altogether.
So it's not about throwing in the towel. It's just about giving yourself some space to breathe and regain some perspective.
Exactly. Drawdowns can really cloud our judgment. We start making emotional decisions. Sometimes the best thing we can do is just walk away, clear our heads, and come back with a fresh perspective.
That makes sense. And I imagine that having a clearly defined loss limit can be helpful during those drawdowns, like a point where you say, okay, I need to step away and reevaluate everything.
Absolutely. Having that line in the sand, prevents you from chasing those losses and making those impulsive decisions that can make the drawdown even worse.
So we've talked about handling those tough periods, those inevitable drawdowns, but let's switch gears and talk about a different challenge, patience. It's a word we hear all the time in the trading world. What does it actually mean? And how do we actually cultivate patience in such a fast-paced environment?
Patience, it's about waiting for the right setups, letting your trades play out, trusting the process even when it's uncomfortable. Impatient traders, they jump into trades too early, they exit too soon, or they overtrade, all of which can really hurt their performance in the long run.
Yeah, I think we've all been there, getting that FOMO feeling, jumping into a trade, just because it seems like everyone else is making money on it, only to regret it later.
FOMO, that's the enemy of patience. One way to combat that is to create a pre-trade checklist, a set of criteria that must be met before you even consider taking a trade.
So my checklist might include things like, is this trade aligned with the current market trend? Does the risk-reward ratio meet my minimum standards? And do I have a clear exit strategy?
Exactly. A pre-trade checklist keeps you objective even when the market's moving fast and your emotions are running high.
This is great, but I have to be honest, waiting is tough.
Yeah.
Especially when you see the market moving without you. It feels like you're missing out on opportunities.
I get it. That's where the mental game comes in. One way to build confidence and patience is to start journaling those successes, specifically those times when waiting for the right setup led to a profitable trade.
So if I wait for the price to hit my predetermined support level before I enter a trade, and that results in a profit, I record that in my journal. I'm basically showing myself the benefits of being patient.
Exactly. Over time, as you see those positive results, it becomes easier to trust the process.
It's like training your brain to recognize that patience can actually be profitable. Okay, so we've talked about patience, but what about discipline? How important is discipline to this whole idea of the profitable mindset?
Discipline is the foundation, the bedrock, upon which the entire profitable mindset is built. It's the ability to execute your strategy consistently, even when you're feeling tempted to deviate. Without discipline, it doesn't matter how much knowledge or preparation you have, it all falls apart.
So it's about having that mental toughness to follow through, even when we're feeling scared or greedy or frustrated.
Exactly. It's about mastering those impulses and sticking to the rules that we've set for ourselves.
But that's easier said than done. How do we actually develop that discipline? Where do we even begin?
A clearly defined trading plan.
Okay, we talked about trading plans earlier, but I'm guessing they're even more important for this whole discipline piece.
Absolutely. Your trading plan, it's your roadmap, it's your set of rules for navigating the markets. It should include everything, your entry and exit criteria, your risk management rules, your position sizing guidelines, your overall goals, and your metrics for success.
So it's not just this vague idea of what we want to achieve.
Yeah.
It can actually document a step-by-step guide for how we're going to get there.
Exactly. Without a trading plan, it's like trying to build a house without a blueprint. It's just going to be chaos, and the end result is probably not going to be what you wanted.
Okay, I get it. So I've got my plan, my blueprint. Now how do I stick to it? How do I resist the urge to make those emotional, impulsive decisions?
A structured routine can be incredibly helpful. It reinforces that discipline.
So for example, I might review my trading plan every morning before the market opens. I'll execute my trades based on those predefined criteria, and then I'll journal and analyze my performance each evening.
Exactly. And checklists are a great way to stay on track. Before you take any trade, make sure it meets your criteria. Is it aligned with your strategy? Is the risk-reward ratio favorable? Have you set your stop loss and your profit targets?
It's like we're trying to remove emotion from the equation and just let those predetermined rules guide our decision-making.
You got it. And even with a plan and a routine, we're still going to face temptations. Those moments when we feel that urge to break the rules, to chase a hot tip, or to try to make up for a loss quickly, that's where things like taking a pause before acting, setting alerts and automations, and finding an accountability partner can really make a difference.
So if I'm feeling that urge to take a trade that doesn't meet my criteria, I might take a few deep breaths, walk away from the computer for a few minutes, or talk to my accountability partner before I actually pull the trigger.
Exactly. You're putting some space between the emotion and the action. You're giving yourself time to cool down and think rationally.
Okay, so we're creating that structure, that system to help us stay disciplined. But I'm guessing it's also important to track our progress to make sure we're actually sticking to the plan.
Absolutely. Self-reflection is key. And your trading journal, that's your best tool for that. It's not just about recording the numbers, it's about analyzing your decisions, identifying areas where you need to improve, and holding yourself accountable.
So if my journal is showing that I'm consistently breaking my own rules, maybe I need to go back and adjust those rules or find ways to strengthen my discipline.
Exactly. And don't forget to celebrate those wins, too. You know those times when you successfully resist temptation and you stick to your plan?
It's about acknowledging those small victories, those moments of discipline, even if the trade itself doesn't work out.
Exactly. They're all building blocks for long-term success. And speaking of long-term success, I think there's one more key element of the profitable mindset that we need to discuss: detachment from outcomes. It can be a tough concept to grasp, but I believe it's absolutely essential.
Okay, let's dive into that. I know a lot of traders struggle with this. It's so easy to get caught up in the wins and the losses, the emotional roller coaster of the markets. But you're saying that overemphasizing those outcomes can actually be detrimental.
It can. It leads to emotional decision-making, second-guessing, and ultimately burnout. The key to a sustainable mindset, a profitable mindset, is to shift our focus away from the outcome of each individual trade to the process of executing our strategy effectively.
Okay, that makes sense logically.
Yeah.
But it also sounds a bit paradoxical. How can we achieve those desired outcomes if we're not actually focused on the outcomes?
It's about understanding that we can't control the market. We can't predict with 100% certainty whether a trade is going to be profitable or not.
It's about accepting that uncertainty.
Exactly. Detachment is about surrendering to the uncertainty of the market, but doing so with a clear plan and a disciplined mindset.
It's about focusing on what we can control, our actions, our decisions, not what we can't control, which is those random fluctuations of the market.
You nailed it. And this shift in perspective, it has profound benefits for our performance and for our well-being.
Okay, I'm intrigued. What are some of those benefits? How does detaching from outcomes actually translate into better trading?
Well, for one, it leads to greater consistency. When we're not obsessing over each individual trade, we're more likely to stick to our plan and execute our strategy with discipline.
So we're not second-guessing ourselves or letting those wins and losses throw us off track.
Exactly. We're making decisions based on our rules, not on our emotions. And it leads to greater emotional stability.
I can see that. If we're not constantly on that emotional roller coaster, we're going to be more calm, more balanced, and that's so important for making good decisions.
Absolutely. And here's the interesting part. Detaching from outcomes can actually lead to better results in the long run.
Okay, that sounds a bit counterintuitive. How can not focusing on results actually lead to better results?
Think of it this way. When we're not consumed by that need to be right on every single trade, we're free to focus on what truly matters, executing our strategy effectively. We're not letting our ego get in the way.
It's like that saying, the less you care, the more you win.
That's a great way to put it. It's not about being indifferent to results. It's about understanding that focusing on the process, doing the right things consistently, ultimately leads to those better outcomes.
This makes a lot of sense, but I have to be honest. Detaching from outcomes, it's easier said than done. So how do we actually put this into practice? What are some concrete steps we can take?
Well, there are a few practical strategies that can help. First, define and celebrate your process goals.
Process goals?
Yeah. Instead of setting goals based on profits, which, as we've talked about, we can't fully control, we set goals based on the actions that we can control.
So instead of saying, I want to make $10,000 this month, I might say, I'm only going to enter trades that meet my predefined entry criteria.
Exactly. You're shifting your focus from the result to the process to those actions you're taking to achieve that result.
And then we celebrate those moments when we successfully stick to our process, those moments of discipline.
You got it.
Adherence to the plan.
So even if your trades didn't result in a profit, if you followed your plan for the week, that's a win.
It's about recognizing and rewarding those small victories that lead to that long-term success.
Exactly. Another helpful technique is to reframe those losses. Instead of viewing them as failures, we view them as feedback opportunities to learn and improve.
So asking ourselves, what can I learn from this? Did I follow my plan? What can I do differently next time?
Exactly. And this is where risk management comes in.
Okay, how does risk management tie into this whole detachment thing?
When we define our risk before we enter a trade or investment, we know our maximum potential loss, and that allows us to accept any outcome without regret.
So if I'm risking 1% of my capital on a trade, I know that even if that trade goes against me, it's not going to wipe out my account. And that knowledge, that peace of mind, helps me to detach from the outcome of that specific trade.
Precisely. It's like having that safety net, that buffer that allows us to take calculated risks without those risks controlling our emotions.
This makes sense.
Yeah.
And I'm guessing those mindfulness techniques we discussed earlier can also play a role in this whole detachment process.
Absolutely. Meditation, deep breathing, these practices can help us stay grounded, stay present, and be less reactive to those constant market fluctuations.
So we're training our minds to stay focused on the process, on the present moment, rather than getting caught up in what happened in the past or what might happen in the future.
Exactly. And finally, there's one more element of detachment that I want to emphasize, separating our personal worth from our trading performance.
Okay, that sounds important. What does that mean in practical terms?
It means recognizing that a losing trade doesn't mean we're failures, and a winning trade doesn't mean we're geniuses. Our trading performance, it doesn't define us as human beings.
So we're detaching our ego from the results. We're recognizing that everyone makes mistakes and that our worth as individuals is not tied to our financial success or failure.
You got it. And this allows us to approach trading with a much clearer and more objective mindset.
This has been a really powerful conversation about detachment. But before we move on, I want to ask, how do we make these principles stick? How do we make detachment a part of our daily routine?
Journaling is really helpful. When we document our trades, we shift our focus away from the outcome and onto the process. We're writing down our pre-trade analysis, our rationale for entering the trade, our adherence to our rules, and our post-trade reflections.
So it's not just about the numbers. It's about the thinking behind the numbers, the process that led to that outcome.
Exactly. And by analyzing our trades, we can see whether we're consistently following our plan, whether emotions are creeping into our decision-making, and where we need to improve our process.
It's like having that feedback loop. It helps us to refine our approach and to detach from those emotional highs and lows that can really sabotage our success.
Exactly. And as we focus on the process, our confidence grows. Even if a trade doesn't work out, if we followed our plan, managed our risk, and learned from the experience, we can still feel good about the process.
It's about recognizing that you're doing the right things even if the market isn't cooperating in that particular instance.
That's the essence of detachment.
Okay, but let's be real. Detachment, it's not something that happens overnight. It's a skill that takes time and effort to develop. And it will be tested, especially when we're facing challenging market conditions.
You're absolutely right. When we're in a drawdown or the market's moving against us, it's easy to slip back into those negative emotions and start doubting ourselves and our strategies.
So that's when detachment is most crucial, but also the hardest to maintain. What are some things that we could do in those moments to stay grounded and to prevent those emotions from taking over?
One of the most effective strategies is to simply reaffirm your commitment to the process.
So instead of panicking and making those rash decisions, we take a step back, we reassess, and we remind ourselves of our plan and why we're trading in the first place.
Exactly. Remember, detachment doesn't mean being indifferent to the results. It's about aligning your ambition with your actions and accepting that you can't control the market, but you can control yourself.
It's about having that clear vision for the future, but focusing on the steps that you can take today to move towards that vision.
Exactly. It's about enjoying the journey and the process of growth and learning rather than just obsessing over the destination.
This has been such a helpful conversation about detachment. But before we move on, I want to touch on one more topic that I think is closely related: adaptability. We've talked a lot about the importance of having a plan, a strategy to guide our decision-making. But what happens when the market changes, when our strategy stops working? How do we adapt without losing confidence or getting stuck in a rut?
Adaptability is crucial. The markets are dynamic. They're always evolving. What worked yesterday might not work today. To be successful, we need to be able to adapt without losing sight of our core principles.
So we're not throwing our plan out the window. We're just making those tweaks, those adjustments to accommodate those changing conditions.
Exactly. And this requires a certain mindset, a willingness to let go of our attachment to a particular strategy or approach if it's no longer serving us.
That can be tough because we tend to get attached to things that have worked for us in the past. But you're saying we need to be open to change, to trying new things, and to recognize that what got us here won't necessarily get us there.
That's exactly it. We need to recognize when it's time to adapt and then make those changes without letting those changes shake our confidence.
Okay, I'm on board with the idea of adaptability. But how do we know when it's time to adapt? What are some of those signs that our strategy might need a little tune-up?
Well, changes in volatility are a big one. If the market suddenly becomes much more volatile, you might need to adjust your position sizes or widen your stop-loss orders to accommodate those larger price swings.
So our risk management needs to be adaptable as well, not just our strategy.
Absolutely. And on the flip side, if the market becomes less volatile, you might tighten your risk management or look for smaller, more frequent opportunities.
It's about matching our approach to the current market conditions, not trying to force our strategy to work in an environment that's no longer suitable.
That's a great way to put it. And sometimes it's not just about tweaking our risk management, it's about changing our approach altogether.
Okay, can you give me an example of that?
Sure, let's say you're a trend follower and the market has been trending nicely for months. Your strategy's working, you're making money, but then the market starts moving sideways, those trends disappear and you find yourself getting chopped up. That's a sign that it might be time to switch to a different approach.
So instead of stubbornly trying to force my trend following strategy to work in a market that's no longer trending, I might switch to a mean reversion strategy, a strategy that's designed to profit from those oscillations within a range.
Exactly. It's about recognizing that different strategies work better in different market environments. The key is to have a toolbox of strategies that you can draw from depending on what's happening in the market.
I like that. It's about having the flexibility to adjust our sails as the wind changes. But it's not just about price action, right? We also need to be aware of those external factors, those things that can impact the market, like economic data, news events, geopolitical developments.
Absolutely, you're right. Those macro factors, they can have a huge impact on market sentiment and volatility, and we need to factor them into our analysis and our decision-making.
So if we see a major news event that could potentially impact the market we're trading, we might adjust our strategy, our position sizing, or our risk management rules accordingly.
Precisely. It's all about staying informed and being able to adapt to those unexpected events that can really throw the market for a loop. And speaking of things that can throw us for a loop, let's talk about overtrading. It's a problem that a lot of traders struggle with, and it can really derail our progress if we're not careful.
Overtrading, it's a slippery slope. It often starts with a few impulsive trades, maybe to try to make up for a loss or to chase a hot tip, but it can quickly spiral out of control.
Exactly. And it's driven by those same emotions we've been talking about. Fear, great impatience, the need for constant action.
So let's define it. What exactly do we mean when we say overtrading?
Overtrading is when we trade more frequently than our strategy dictates, when we increase our position sizes beyond our risk limits, when we're trading impulsively without doing proper analysis or having a clear plan, Essentially, it's any trading activity that falls outside of our predefined rules.
So it's about recognizing those moments when we're deviating from our plan, when we're letting our emotions drive the bus, rather than logic and discipline.
Exactly. And there are a number of reasons why traders fall into this trap.
Let's break those down. What are some of the most common causes of overtrading?
Boredom's a big one. When the market is slow or we're not seeing any setups that fit our strategy, it can be tempting to just start clicking buttons and placing trades just to feel like we're doing something.
It's like we need that action, that stimulation to feel like we're engaged in the market.
Exactly. And then there's FOMO, the fear of missing out. When we see others making money or the market is moving quickly, it can be really hard to resist that urge to jump in and get a piece of the action.
I think social media can really amplify that FOMO. We're constantly bombarded with images and stories of other people's success, and it's easy to start comparing ourselves and feeling like we're falling behind.
You're right. Social media can create a very distorted view of reality. And then there's revenge trading, which is driven by that desire to make up for those losses quickly.
So if I take a loss on a trade, I might feel tempted to double down on my next trade to try to win that money back and erase that feeling of defeat.
That's a classic example of revenge trading. And unfortunately, it often just leads to even bigger losses.
It's like we're letting our emotions take the wheel and drive us further and further down a dangerous road.
That's a great analogy. And then you've got those psychological biases that can contribute to overtrading. Overconfidence can lead us to believe that we can beat the market, that we have some special edge or ability that allows us to consistently pick winners.
So instead of recognizing that trading is a probabilistic game, that there will always be losing trades, we start to think that we're somehow immune to those losses.
Exactly. And that overconfidence can lead to us taking too much risk, which of course increases our chances of losing.
It's a vicious cycle. And then there's impatience that need to see results immediately, which can lead us to force trades and ignore our risk management rules.
Impatience is one of the biggest enemies of good trading. It prevents us from waiting for those high probability setups and from letting our winners run.
Okay, we've talked about the causes of overtrading. Well, what about the impact? What are the consequences of this type of behavior? How does it affect our bottom line and our overall well-being?
Overtrading has a lot of negative consequences, both financially and psychologically. On the financial side, it leads to higher transaction costs. The more we trade, the more commissions and fees we're paying, and those costs eat into our profits.
It's like death by a thousand cuts.
Oh.
We might be winning some trades, but those profits are being chipped away by the constant churning of our account.
Exactly. And then there's the impact on our risk management. When we're overtrading, we're often not managing our risk effectively. We're taking bigger positions than we should be, or we're not using stop-loss orders.
So we're basically increasing our potential for losses, both in terms of how often we lose and how much we lose when we do.
Precisely. And those bigger losses can really set us back financially and emotionally.
It's like 2 steps forward, 3 steps back.
That's a good way to put it. And over time, all of this leads to diminished returns. The more we trade, the more we expose ourselves to those random market fluctuations, and the less likely we are to achieve those consistent, sustainable profits.
Okay, so it's clear that overtrading is bad for our financial health. But let's talk about the psychological side of things.
Right.
How does overtrading affect our mental and emotional well-being?
It can be really damaging. Overtrading leads to increased stress. We're constantly checking the markets, placing trades, worrying about the outcomes. It's exhausting.
And I can only imagine how those losses, those big swings in our account balance can really take a toll on our confidence.
They can. We start to doubt ourselves, doubt our strategy, doubt our ability to succeed in the markets. And that can lead to a loss of enjoyment.
It's like that feeling of burnout. You're just running on fumes. You've lost that passion, that excitement that you had when you first started trading.
Exactly. It becomes this vicious cycle. You're stressed, you're losing money, you're doubting yourself, and you're not even enjoying it anymore.
So overtrading is basically a recipe for disaster, both for our portfolios and for our minds.
It can be. And it's something that we need to be very aware of and actively work to avoid.
Okay, so let's talk about solutions. How do we break free from this trap of overtrading? What are some strategies that we can put in place?
The first step is to create a trading plan and stick to it.
We've talked about trading plans a lot today, but I'm guessing they're even more important when it comes to combating this overtrading issue.
Absolutely. A detailed trading plan, it helps reduce that impulsivity. It defines our entry and exit criteria, our position sizing rules, our overall risk management strategy.
So we're creating that structure, that set of guardrails that keeps us from veering off course and making those emotional decisions that can lead to overtrading.
Exactly. It's about having those rules in place and following them no matter what.
So even if I see what looks like an amazing opportunity, if it doesn't fit my predefined criteria, I resist that urge to jump in.
Exactly. Discipline is key. And it can also be helpful to set trade limits for yourself.
Trade limit.
Yeah, a maximum number of trades that you'll allow yourself to take each day or each week.
So if my plan says I can take 3 trades per week, and I've already taken those 3 trades, I resist the urge to take any more, even if I see what I think is a guaranteed winner.
Exactly. It's about staying within those boundaries even when it's tough.
Okay, I like that. It's like creating a budget for our trading activity. We decide in advance how much we're willing to spend, and we stick to that budget no matter what.
That's a great analogy. And we can also use technology to our advantage. Things like alerts and automation can really help us to reduce those impulsive emotional decisions.
Okay, how so?
We can set alerts for those key price levels or conditions that we're looking for. When those alerts are triggered, we can have automated orders in place that will execute those trades for us. We don't even have to click the button ourselves.
So if my strategy is to buy stocks when they break out above a certain resistance level, I can set an alert that will notify me when that happens. And then I can have an automated order that will buy the stock for me when that alert is triggered.
Exactly. That way you're not sitting there staring at the screen constantly, which can lead to that impulsivity and overtrading. You can step away knowing that your alerts and your automated orders are taking care of things.
That makes a lot of sense. And I'm also guessing that scheduling regular breaks throughout the day can be helpful. Just to step away, clear your head, and come back with a fresh perspective.
Absolutely. Those breaks are essential.
Yeah.
It's about preventing burnout and maintaining that clear, rational mindset that we need to make good decisions.
So maybe I go for a walk, I meditate, listen to some music, or just do something completely unrelated to trading.
Exactly. Anything that helps you to detach, relax, and recharge.
Okay, we've talked about trading plans, trade limits, alerts, automation, and breaks. But there's one more tool that I think is absolutely essential for breaking free from overtrading our trading journal.
Journaling is such a powerful tool for this. It can help you identify those patterns of overtrading, and it can also help to reinforce that discipline.
So I can look back at my journal and see those times when I'm most prone to overtrading, what my rationale was for those trades and how I was feeling at the time.
Exactly. And by documenting all of that, you start to see those triggers, those things that lead you to make those impulsive decisions.
It's like having a record of your thought processes, your emotions, and your actions all in one place. And then you can analyze that data and start to make those conscious changes to your approach.
Precisely.
Yeah.
And it's not just about identifying those negative patterns. It's also about recognizing those times when you successfully resist the urge to overtrade, when you stick to your plan and make the disciplined decision.
So by acknowledging those wins, those moments of restraint, we're actually reinforcing those positive behaviors and strengthening that discipline muscle.
Exactly. Journaling helps us to become more self-aware and to make those adjustments that lead to more consistent, more profitable results.
This is all great advice, but at the end of the day, it really comes down to shifting our mindset, right?
It does. Instead of focusing on trading frequently, we need to focus on trading effectively.
So it's not about the quantity of trades. It's about the quality of those trades. It's about making sure that every trade we take is aligned with our plan, our goals.
And our risk tolerance.
Right. And it's about accepting that sometimes the best trade is no trade at all.
That's so important. Being selective, waiting for those high probability setups that really fit your strategy, and being okay with passing on those tempting but ultimately low quality opportunities.
This has been a really eye-opening conversation about overtrading. But before we wrap things up, I want to touch on one more challenge that I think a lot of traders struggle with, staying motivated and focused over the long haul. I've found that you can have a solid plan, a winning strategy, but it's a whole other ballgame to actually maintain that enthusiasm and that commitment when you're facing drawdowns, market volatility, or just the day-to-day grind of trading.
You've hit on a crucial point. Trading and investing, they're marathons, not sprints. And just like any marathon runner, we're going to hit those walls. We're going to experience exhaustion, self-doubt, and that temptation to just throw in the towel.
So how do we fight that? How do we stay motivated? How do we keep that fire burning, especially when we're feeling discouraged or burned out?
Well, I think it starts with understanding the nature of motivation itself.
Okay, let's talk about that. What is motivation and why does it seem to fluctuate so much? Some days I feel like I can conquer the world, and other days it's hard to even open my trading platform.
Motivation, it's that inner drive that propels us towards our goals. And when it comes to trading, a lot of us rely on external motivation, meaning Our drive is fueled by things outside of ourselves, things like market performance or profits or recognition from others.
So when the market's doing well and our account balance is going up, we feel motivated and excited. But when the market turns against us or we hit a rough patch, that motivation can vanish pretty quickly.
Exactly. And that's why it's so important to cultivate intrinsic motivation, that drive that comes from within, rather than relying solely on those external factors.
Okay, so how do we do that? How do we develop that intrinsic motivation? How do we find that drive that's not dependent on, whether the market's up or down or how much money we're making?
One powerful way is to set purpose-driven goals. Goals that are aligned with our deeper values and aspirations.
So instead of just focusing on making money, we connect our trading goals to something bigger, something that gives us a sense of meaning and purpose.
Exactly. If your goal is just to make $1 million, that can feel kind of empty, kind of superficial. But if your goal is to achieve financial freedom so you can spend more time with your family or to build a business that gives back to your community, that's a purpose that can really fuel your motivation.
It's about finding that why that resonates with you on a deeper level, that why that's going to keep you going, even when those external motivators like profits are lacking.
You got it. And it's not just about setting those purpose-driven goals, it's also about finding joy in the process itself.
Okay, how do we do that? How do we find joy in the process? Trading can be stressful, it can be challenging, it can be downright frustrating at times.
That's true. But there are also aspects of trading that can be incredibly rewarding. The challenge of mastering a new skill, the excitement of uncovering a winning trade setup, the satisfaction of seeing your strategy play out successfully. These are all sources of joy that we can tap into.
So it's about focusing on those aspects of trading that we genuinely enjoy, the things that keep us engaged and excited, even when the market is being unpredictable.
Exactly. And it's about celebrating those small wins, those little moments of progress along the way.
So maybe I give myself a little reward for sticking to my trading plan for a week, or for successfully managing a losing trade, or for finally mastering a new technical indicator.
Those small wins, they're incredibly powerful. They build our confidence, they reinforce those positive behaviors, and they keep us motivated over the long haul.
This is all great advice. But I think it's also important to acknowledge that even with a strong why, a passion for the process, and that commitment to celebrating those small wins, there are going to be times when we just feel burned out, exhausted. It's hard to muster that motivation. What can we do in those moments to avoid just completely giving up?
Burnout is a real thing in trading. It's that feeling of emotional, physical, and mental exhaustion, and it can lead to some really bad decisions, increased risk-taking, and a total loss of passion for the markets.
So it's not just about feeling tired or lazy. It's a much deeper sense of depletion that can really affect our trading.
Exactly. And the best way to deal with burnout is to prevent it from happening in the first place.
Okay, how do we do that? What are some things that we can do to protect ourselves from burning out?
Setting boundaries is key.
Boundaries? You mean between our trading and the rest of our lives?
Exactly. It's easy to get sucked into that world of trading. You spend hours staring at the computer, constantly checking the charts and the news feeds, and trading starts to occupy your thoughts even when you're not actively in the market.
Oh yeah, I've been there. It's like trading becomes this all-consuming obsession, and it starts to bleed into every other area of your life.
It can. And that is a surefire path to burnout. That's why it's crucial to set those clear boundaries to create separation between our trading activities and the rest of our lives.
So maybe I make a rule that I'm only going to trade for a certain number of hours each day, or I'll take the weekends off completely.
Those are great examples. It's about creating that mental and emotional space, that distance from the markets that allows us to recharge, reconnect with ourselves, and come back to trading with a fresh perspective.
It's about remembering that trading is just one part of our lives, and that to be successful traders, we need to be well-rounded people with interests and passions outside of the markets.
That's so important. And it's not just about setting time limits. It's about taking care of ourselves physically and mentally, too.
So making sure we're getting enough sleep, eating healthy foods, exercising regularly, and managing stress through things like meditation or spending time in nature.
Exactly. It might seem obvious, but those things have a huge impact on our energy levels, our ability to focus, and our overall mood, all of which are essential for successful trading.
And let's be real. When we're feeling good physically and mentally, we're much more likely to make good decisions and to handle those inevitable market challenges with grace and resilience.
Absolutely. And it's also helpful to diversify our activities to find things we enjoy doing outside of trading.
So maybe we pick up a hobby, join a sports team, volunteer in our community, or just spend more quality time with our loved ones.
Those activities are so important for maintaining that sense of balance and fulfillment. They help us disconnect, recharge, and come back to trading with renewed enthusiasm and a fresh perspective.
This has been incredibly helpful, but before we wrap up, I want to address one final challenge that I know can be really tough for traders staying motivated during a drawdown. It's easy to start feeling like you're doing everything wrong when you're facing a string of losing trades. And it can be incredibly difficult to stay focused on your goals when your account balance is shrinking.
Drawdowns are tough. They're a test of our resilience, our discipline, our commitment to the process.
So how do we stay motivated when it feels like the market's working against us? What can we do to keep going and avoid just giving up?
One of the best things you can do is review your past performance. Look back at your trading journal and remind yourself of those times when you faced similar challenges, when you felt discouraged but you persevered and you came out stronger on the other side.
So it's about recognizing that we've been through tough times before, that we've overcome obstacles, and that we have the ability to do it again.
Exactly. It's about reminding yourself of your own resilience and your track record of success. And it can also be helpful to shift your focus back to the process.
So instead of obsessing over those losses, we focus on executing our strategy effectively. We make sure we're following our rules, managing our risk, learning from every trade, regardless of the outcome.
You got it.
Yeah.
It's about maintaining that discipline, that consistency, trusting that your strategy has an edge, and knowing that if you continue to do the right things, the results will eventually follow.
It's about having faith in the process, even when the market is testing your patience.
That's a great way to put it. And sometimes it can be helpful to temporarily reduce your risk during those drawdown periods.
So maybe we scale back our position sizes, or we take a step back from the market altogether, just to give ourselves some breathing room and to protect our capital and our mental well-being.
Exactly. It's not about giving up. It's about making a strategic decision to regroup and come back to the market with a fresh perspective.
Okay, those are some great practical tips. Are there any mental techniques or strategies that we can use to help us stay positive and boost our motivation during those tough times?
Visualization and affirmations can be powerful tools.
Can you explain how those work?
Sure. Visualization is basically creating a clear mental picture of yourself achieving your goals.
So if my goal is to become a consistently profitable trader, I might close my eyes and visualize myself confidently, analyzing charts, executing my trades with precision, and watching my account balance grow steadily over time.
Exactly. And affirmations, those are positive statements that you repeat to yourself to reinforce your beliefs and your attitudes.
So maybe I write down affirmations like, I am a disciplined and successful trader, or I have the skills and knowledge to achieve my financial goals. And I repeat those affirmations to myself every day.
Those are great examples. And by repeatedly visualizing our success and affirming those positive beliefs, we start to reprogram our subconscious minds. We create a more positive and empowering self-image.
It's like we're planting those seeds of success in our minds. And with consistent nurturing, those seeds will eventually grow into the reality that we desire.
That's a beautiful way to put it. And at the end of the day, it all comes down to this. The profitable mindset, it's not about any one specific strategy or technique. It's about cultivating that inner strength, that resilience, that unwavering belief in ourselves, and our ability to achieve our financial goals.
This has been such an insightful conversation. Thank you for joining us today on the Profitable Mindset Podcast. And we look forward to diving into more mindset strategies with you in our next episode.